Are the markets now more worried about the consequences of what the Fed has done than what they're going to do next? And is recession now the operative driver for what's going on? Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. And that is the question that we are asking ourselves after last week's price action. It was admittedly an abridged week. It was a week of reduced liquidity thanks to the U.S. Independence Day holiday. But nevertheless, we got a little bit of what we bargained for in looking at that NFP report on Friday. It seems like there may be something of a shift occurring in markets, a bit of a regime change, perhaps. And what that could mean might have significant watershed level consequences for how these markets behave, not only for the rest of the year, but perhaps thereafter. Now, it is one release. It is early days yet. But we are going to have a tremendous amount of fodder to follow this narrative this week. So what we're going to do is we're going to set up exactly what it was that showed up in that jobs report's response and how that might frame our thinking for what's coming up this week, what we'll be looking for to see if the signal is discernible and if indeed a major sea change is afoot. So let's first take a look at what happened with that NFP report to see what all we're even talking about. Here is the S&P 500, and the arrow there is pointing at Friday's price action. I very specifically kept everything else off of this to really give the sense of exactly what is going on. Because I think what's really important here is to understand, if you were to just look at the price action, just look at the chart, what it tells you. And what it seems to say is that whatever came out from the jobs report, the markets didn't like. But when you look at what it was exactly that the markets were responding to, this kind of a candle really is quite striking. So we get NFP at 209,000 jobs added. That's under the 225 or 230, depending on which aggregator's forecast you were looking at, that were expected. So fewer jobs created. The revisions introduced into the preceding 2 months data, further disappointment. 110,000 jobs of an overestimate shaved off there. So let's call it cumulatively, the NFP number was about 150, 160K worse on the past 3 months of data than the markets were anticipating. Now, that might have been read in the dynamics of the markets over the past 6 months. And really, if we go significantly enough back to the beginning of the tightening cycle's announcement and unveiling at the middle of 2021, this might have been seen as good news, because the number wasn't so terrible as to be eye-wateringly bad. And we might have seen the markets conclude, oh, okay, this means the Fed doesn't need to get any more aggressive. And we see them trying to think that, because what we see on this candle is a long wick higher. So over the course of the day, the market tried to rally. In fact, it tried nearly to erase all of the prior day's loss. Then by the end of the session, it reversed all the way back down, erased all of those gains, and actually closed the day lower. That's a very ugly close and speaks to not just a negative response to a weak number or a weaker set of numbers than anticipated. It speaks to the attempt to see them positively and then capitulation. And capitulation is a strong emotion. It can often precede follow-through in markets. There's important confirmation that we find from other assets. So when we look at the 2-year note, we notice that indeed, it's not that the market didn't think this would matter for the Fed. The 2-year note is a little bit higher on Friday, which means that front-end bond yields a little bit lower. So the market saw the soft number and said, okay, this probably means the Fed doesn't need to be quite so aggressive. They've obviously talked themselves into quite a bit of a hawkish posture here. So we probably don't get a big shift in the immediate outlook. You can see the move here is fairly modest. But nevertheless, over about a 2-year horizon, this probably means rates look a little bit lower than we thought. So the relief to Fed hawkishness did occur. Just the markets didn't like it. They didn't think that it was a good thing, looking at the S&P here. And then, of course, we get the Japanese yen. This thing tends to rally when yields decline, particularly in recent times. There's been a focus on the immediate Fed rate hike cycle. So to see the yen rally with this kind of emphasis here seems to imply that there is a significantly lower view on yields, at least over the near to medium term, that entered into markets with this NFP report. This is, of course, because Japan's interest rates are zero or near zero for the better part of 4 decades at this point. It was easily the worst performing currency last year because while all of these major central banks, the Fed leading among them, were busy raising rates to fight inflation, Japan didn't do any of it because most of their inflation is imported, not domestically generated. They don't see follow through there. Their disinflation and borderline deflationary risk largely comes from local conditions, local demographics. And so as rates rise everywhere, except Japan, there is an incentive to borrow cheap in yen and buy assets and currencies that yield more with that borrowed money, because, of course, that is a positive and an earning income stream of a yield differential. So to see the yen rally here implies that that kind of a thing looks less attractive. And people said, well, it looks like yields may not be as high. These yield differentials may not be as great as we thought. There maybe isn't as much of an income potential here. Let's unwind some of these borrowed yen exposures and buy back some of this yen, cover some of these shorts. So in all, you get the yield response. You get the adjustment, at least over the medium term, to a less hawkish Fed view over about a 2-year window, 3-year window. And yet risk doesn't like it. And what that seems to imply is that the market is becoming less worried, as we say, about the Fed is going to do this at the next meeting or that at the next meeting, and more worried about the accumulating consequences of what's been done already. They are plainly appearing to worry about imminent recession, or at least the inevitability of one within a forecastable view. Now, again, this is one piece of data. And so what we're going to see this week is, are the markets prepared to build on this? And the conversation starts, shock of shocks, with what is probably the biggest item on the calendar, the US CPI report that is going to be due out here on Wednesday. The expectation is that we're going to come down to 5% on the core reading, and that we're going to come down to 3.1% on the headline. If we consider what that amounts to, that's a climb down from 4 on headline and a climb down from 5.3 on the core. That would be the lowest core reading since November of 2021. Now, one could look at this and say, well, what's going on here is a good thing. This means a less activist Fed. But in the context of what we've been looking at with how markets responded to NFP, this is exactly the kind of test that we would be eager to conduct to see if this comes in soft, does the market read it instead as bad news and says, this is an economic downturn in the works. And indeed, the risk that it comes in soft is not trivial. We look at the ISM numbers that came out last week and the prices components therein, we can see clearly that whatever else was going on in divergence between the services and manufacturing sector, and that divergence is acute, make no mistake, we are seeing disinflation continue, and most importantly, that disinflation is steady and consistent on the service side, which is at this point what the Fed is most worried about. We've talked at length about the idea that the Fed has managed through its efforts so far and through the mending of supply chains, mostly outside of its own action function, to get to an inflation rate that's come down now from 9 to about 4. But that goods inflation has been largely squeezed out, so mending supply chains has paid the dividends that there were to be collected. Energy is now a net disinflationary factor. Food inflation is still holding up a bit, but it's a relatively small component. And with the reversal in sugar prices, that's probably going away over time. It's that big wedge of services excluding food and energy that's most troubling. And if we look at these ISM numbers, that's the orange line there, heading consistently lower over recent months. So if this is the story, then indeed CPI might undershoot. And if it does, the story might well be, this is a recession in its infancy. Stocks lower, yen higher, yields lower, perhaps. And then, of course, we'll see what happens with the US dollar. It has been much better supported against cyclical counterparts like the Aussie that it has against the yen, where it isn't the anti-risk favorite, the anti-yield favorite. It's not done well against the euro either, on much the same grounds in this environment. So we'll see how that continues to behave. But here is the perfect opportunity to test if what we saw on the response to NFP has legs to continue. There's a bit of a moderating factor toward the end of the week with the University of Michigan Consumer Confidence Index. We're expecting a little bit of an improvement in the overall sentiment index and parallel notches higher in both the expectations and the current conditions gauges. That's probably a reflection of inflation coming in and the Fed being successful in getting it from 9 to 4. But the overall direction, as we can see, is still much lower than it was toward the beginning of where the Fed started to really angle for this tightening. We'll see if there's any kind of a disappointment here. If this does hold up, it might be a little bit of a salve for battered markets in the wake of CPI if that comes in soft. And of course, if this misses, things could get, frankly, quite dire indeed. As it stands currently, the market still expects overwhelmingly that there's going to be a Fed rate hike somewhere between July and September, with the odds favoring July. 89% probability of an increase already baked in there. 22 of 25 basis points already baked in there. We get to that rate hike being fully priced in by September, with a slight chance for a further increase, a 17% chance. That starts to get a little bit higher as we get into November, but never really gets over the 50% threshold. So at no point do markets see a better than even chance for two more hikes before this cycle ends. They see one more. As we get to the calendar year turn, we can see we start to have the creeping speculation that maybe there is a cut that gets on the menu. You can see come May is where that cut is actually on the board. So you can see the number of hikes cuts column. By May, it's basically zero. So whatever hike there was to be had in September, you can see there it's 1.17. So in other words, one hike relative to now. Come May, it's no hikes relative to now, which implies that that one hike has already been given away by May. And then, of course, cut expectations start to build. One cut seen in June, but no later than July. A second one in September. A third one in November. And then nearly there on a fourth one come the beginning of 2025. So the markets are clearly looking for a significant easing in the back half of next year still, even as they expect continued tightening at the front part of the cycle. And this too would be consistent with recession fears, implying that all of what the Fed is saying now will be, in fact, the hawkishness that they've talked themselves into, but that the consequences then begin to mount. And this is that middle of the road, middle of the curve recession, somewhere within about a year and a half to 2 years' time. Also on the calendar, to fuel this story, is the Bank of Canada policy announcement. Now, here we can see there's a very similar story to what we saw last time. So there is a hike expected and fully baked in over the next two meetings, either this month or September. If you look at the box there, the black box on the bottom of the chart, you can see for the September 6th meeting, the hike is all the way priced in. Then in October and November, there is the possibility for a further increase, but it is very narrow. Come December, it's at best 50-50. So it looks like we're going to get one more hike this year, and that's it. And if you look at the curve, we're currently at 4.75. You can see we top out in about 6 months' time at 5.13. So we never really get to 5.25. And from there, easing. So if we look at the current situation, then it looks a lot like what we saw in the preceding month's meeting, where in fact there was a surprise hike. So if we consider how this was configured before the announcement in June, it was a little bit lower of a percentage. It was about 45% likelihood of a hike. But then by July, the hike was there. So we were talking about a 60-40 split favoring July. Here we're talking about a 60-40 or even a 70-30 split favoring July rather than September. Nevertheless, we are in an environment, it would seem, where if there were a hike, there's something to bake in there. The market is not fully on board with it happening this week, so there's a bit of a wedge there for markets to reprice expectations. If this veers on the hawkish side, if this veers on the dovish side, there might be implications far broader than Canada. And we saw this in spades last month, which is why we're so focused on it this time. Here was the response last time. So you can see there's the surprise hike. The Canadian dollar, not surprisingly, goes higher. But then the U.S. two-year yield goes up. And the December 23, so end of this year, Fed funds outlook goes up. And all three of them spike in tandem, which seems to suggest that if Canada feels the need to keep tightening and inflation is too high there, it's probably the same thing in the U.S. And that makes sense because the U.S. is 73% of Canada's exports. So just a crushing amount. So the sensitivity that Canada has to U.S. demand is huge. If there is inflation that's too hot in Canada, it's because demand in the U.S. is too hot. More likely than not. So if we get a surprise hike again, or at least if the BOC chooses to hike where they're not fully expected by markets to do it in a foregone conclusion, this is a given kind of way, then the sense might be, okay, well, the Fed could be reinforced in its hawkish leanings. If, on the other hand, the Bank of Canada blinks and says, maybe not this time. We'll see you in September. They might still hike in September, but the markets might look at that to say, okay, there's some concern about what's going on in the U.S. business cycle here. That Canadian policymakers are starting to receive. And that would feed into these inflation risks. And finally, there's Chinese trade data. Expectations here for another steep decline in exports, 10% year on year. And in parallel, another decline in imports too, this time down 4.1% year on year. They were down 4.4 last month, and exports were down 7.5. So all of this continues to point to a tremendously weak state for the world's second largest economy. Because these declines seem to suggest that external and internal demand are missing. And what we've been talking about here is what the upshot of this has been is China's loss of global market share when it comes to its portion of world trade volumes. So you can see here, global trade itself is down. That's the dark blue line here. And that's, of course, something that you might expect because global central banks are busy trying to cool demand. They're raising interest rates. The Fed is, of course, out in front. It's not the only central bank doing it. And so global activity in general is slowing, but China is slowing faster. And you can see its share of global import plus export turnover has gone down from 15% at the peak going into the pandemic to now down to 11.2%, the lowest it's been since the pandemic. So what we're looking at here is a story that continues to disappoint after December's scrapping of zero COVID rules and the letting out of the Chinese population out of lockdowns and the re-engagement of that economy with global markets. And the story here is one we've told before, but it bears repeating. What you see here is the peak in catch-up growth in the U.S. and the Eurozone, China's most important export markets, peaked as early as May and July of 2021. This is where those economies come out of the pandemic, start coming out of the pandemic, and the massive flood of stimulus that they dumped on their economies to offset lockdowns and the missing economic activity there. That's where that impact peaks out. China doesn't then reopen until December of 2022. So it's reopening into a world economy where not only has the impact of stimulus lapsed, or at least run out of steam on the upside and is now waning, but central banks are actively trying to push the other way as of March of 2021 for the Fed, a little bit earlier for some, a little bit later for others. But for China, an economy is still intimately dependent on global demand and on its role as the value add center in the global supply chain, the kind of middle where the importing of raw materials on one side defines the relationship between China and emerging markets. The assembly of those things into finished and semi-finished goods is where China is in the supply chain, and then the reselling, re-exporting of those things, both finished and intermediate, into rich world and demand markets is the relationship that China has with them, which is why China has a deficit with input exporters, but a surplus with end demand consumers. This is where China reopens to find those end demand consumers aren't quite there like they used to be. Both because they've diversified supply chains away from China and continue to do so because China was missing in action for an extra year as relative to everybody else, but also because all of these forces slowing growth have just baseline lowered demand. And if we get another disappointing set of numbers here, as has been the trend in Chinese data, it's tended to undershoot forecasts by an increasingly wide margin in recent months, according to data from Citigroup, then we get into a situation where if we were going to be worried about global growth and China's reopening was a major salve protecting against that looking especially dire, and that certainly was a popular narrative at the start of this year, well, then maybe that narrative is wrong. And if we were concerned about global recession, maybe a disappointing run of numbers out of China compounds those concerns. And that is the macro week ahead. It should be an action-packed one. We'll be following all of it here on Macro Money, Monday through Thursday, as ever, right after Overtime, which is a show that I do with Chris Vecchio, head of Futures and Forex here at tastylive, where we talk about a given day's events, how Wall Street closed, and what to make of all of it. I'm also on with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining on Twitter at Ilya Spivak. Thanks very much for joining, everybody. Happy trading. See you tomorrow.